Appreciate you joining in with that perspective, Hemang. It's always a pleasure. Well, the market's trying to come back, isn't it? I mean, we're down less than 100 points with the banks doing what they're doing, 17,372. Vinay Jaising is Managing Director, Portfolio Management Services at JM Financial Services. Vinay, good to have you with us here. Thank you very much for your time. So just talk to us about whether enough damage has been inflicted or there is more to come, Vinay. I think the last you joined us, you were indeed a bit cautious.
Right. Thank you for this opportunity. It's interesting. Every week we are getting some data which is moving the direction some other way. The current data we've got in the last 1 to 2 weeks have been red hot data coming in terms of labor markets in US, which very simply implies that the US government will have to do something more than earlier as far as interest rates are concerned. As a result of which, if earlier the expectation of Fed stopping at 5% was the peak interest rate, now 5.5 to 6% has become a possibility which people cannot forget. Also, the inflation numbers have been on core PCE a little bit more than expectation at about 5.4% as against 5% last month. That too is not being taken well by the market. So I think there are these two issues which is leading to the global markets, which had moved up as much as 10% till a couple of weeks ago, correcting, and you've seen a bit of pain in the overall markets. India still is one of the worst performing markets this year, down 6-7% as against the global markets, which are probably up by 2-3%. So we are closer to the end for India as far as fall is concerned. But liquidity remains a big concern for us as far as the overall Indian market is concerned. Let's not forget FIs have taken out as much as $3.5 billion just this year out of the markets.
That's well put, Vinay. Hi, good afternoon, Surabhi here. And I was just coming to that point. I mean, you run a PMS business. You tell us, what is the HNI money doing? Because you were talking rates. And as we speak today, the Indian, forget the US, the Indian benchmark yield is at a 3-month high. We're at 7.45%. So, I mean, I'm just guessing for a lot of the HNIs with surplus cash, I guess fixed income and some of these simpler investing options perhaps are making a very compelling case. So, harder questions for equity managers?
So, as far as equity managers are concerned, as the way we look at it is the net cash we have in a portfolio could be as much as 8 to 10%. Because remember, there are ideas, which move down, but there are also, the banks which have done very well in the quarterly results which have come out. You've seen a 45% plus year-on-year growth in the entire bank index earnings. And that is still to come up into the bank index or, the stocks which we like HDFC Limited, HDFC Bank. And we're very positive on earnings of them. So there are good quality names which we think will buckle the trend. But what we're talking about as far as liquidity is concerned is just a 1-month trade. Let me just reverse the question and look at what we were looking at in the month of December. In the month of December end, we were looking at M2 for the world going to zero. And then all of a sudden, China opened up and you saw probably $6 to $7 trillion, from November, December, Jan coming into the global markets. Just in the month of January, I think we saw $3.5 trillion. And you saw the entire market move up. So technically, liquidity is something you should not think of, as far as you are a long-term investor. And, sometimes keeping cash on hand of 10% would help. And I think these are times like today, wherein if you had the cash, you can get some stocks to move up. Just one more comment, 1 year forward when you were to go, you would be discounting F25 numbers. Therein the market would start all of a sudden looking at something close to 17 times multiple. So I think the risk-reward ratio very clearly now is going more with the reward coming for the Indian investor as compared to the risk of probably a 5 to 7% market downside.
Vinay, hi, afternoon. Last year was all about value doing well versus growth. Now in this year, where do you think that argument stands? Do you think value will continue to outperform or is growth going to make a comeback? How would you allocate your portfolio?
So I think you need to marry the two, right? Growth is reasonable. Valuation is what people will go back to what they were speaking for the last couple of decades coming back into the picture. You've seen the problem with, IPOs of fresh, good equities coming into the picture, wherein there were no profitability correct substantially in the market. So you've seen globally, hot assets were being, followed by hot money. with liquidity going away, valuation is something which needs to be very, very strong. But if you can get growth with it, you have a win-win situation. And I think you've got lots of assets which could give you best of both. I'll give you one example. In specialty chemical, you've got Archean Petrochemical, wherein the earnings, our analyst tells us, is going north of 35-40% for not 1 year, but 2 to 3 years. So you can have assets which will have good earnings visibility and relatively strong balance sheets also come into the picture. And it's under 15 times 1 year forward earnings.
Archean. Oh, Archean. Okay, fair enough. The recent listing, right?
That is right.
Okay. What else, Vinay? Now that you whet our appetite, talk about a few other names where you think,
Sure.
Yeah, go on.
Sure. So, see, as far as we are concerned, we are looking at interest rates being higher for longer. So we like the banking sector. In the banking sector, what better than the biggest, which is HDFC Bank? You have HDFC Limited, wherein, you're getting a little bit more alpha compared to banks. So that's one of our favorites. If you look at the cement sector, we think the coal prices coming down have been very good for the sector. And you will see a good quarter or good couple of months also of demand with the capex cycle moving up. As far as the budget is concerned, that's what, the budget was all about. So we like Ultratech Cement out there. Also in the FMCG space, we've seen a lot of correction happen in companies like Devyani. So we like companies like Devyani as well, as long as the QSR chain is increasing. They're growing their, KFCs as well as the Costa Coffees. People are starting moving out a lot more. We know that there is inflation pressure on cheese, which is a short-term pain for QSRs, but that would go away. And we pretty much like the specialty chemical sector. You mentioned Archean, but we also like Gujarat as well as Tatva Chintan. So there are lots of stocks we like in today's market. Most of these companies have had very good results also in the quarter, which came back, unlike the Indian market results overall, which if you take out the financials, you're probably down 7 to 10%.
Okay.
All right, Vinay, we'll leave it there. Good speaking with you, and appreciate you joining in with some of that perspective. So interesting list of names there. Tatva Chintan, Gujarat Fluoro, Devyani Food.